Welcome, everyone, and thank you for joining us. I'm Silvia Garretbuld. I am the CMO at the Estonian Web3 Chamber, and I'm also the CMO at Comply Once, or you can just call me the Crypto Queen of Estonia. And today we are going to explore what it actually takes for crypto payments to move beyond a niche use case and become real payment infrastructure. So we often hear about crypto payments, stable coins, and compliance, but what does it actually take for businesses to adopt these solutions at scale? I'm joined today by Eva-Hannes Gree, who is the founder CEO of Swapin, and Uwe Bohm, who is the COO and co-founder of CryptoSwap. Welcome. It's great to have you all here. And maybe we can start by either of you. Maybe Hannes, you can go first. Give a little introduction. What is Swapin and what are you doing?
Hi. Regarding myself, I started with crypto adoption already in 2013, 14. My first project started in 2016, 17. And on these days, it was very early days for the crypto. And I have been in the industry so many years, so I have very good overview of how it was, how it is, and what to expect.
Yes.
That's nice.
Hi,
Yes.
and yes, so I am Uwe, and I serve as the COO at CryptoSwift, and we are a compliance platform specifically for crypto transfers. So we do travel rule compliance first and foremost, but this is supported with wallet screening, AML, and sanction screening. So it's a broader know your transaction platform that we're building. And I am not such an old school player in the crypto domain. I have been more in the fintech space for over 10 years, but I joined CryptoSwift a year ago and getting my feet wet, and I'm especially inspired by the stable coins and payment use case in this technology.
Thank you. Great to have you here. So let's first start with you, Hannes. So from your perspective, where are crypto payments actually being used today? Are we already seeing real business adoption, or is it still more driven by crypto native users?
Maybe, first of all, it is for crypto native users, but I see that we can define it like use case by use case, like needed solutions. So, or industry by industry, because definitely these industries who don't have access for the banking, or they have very high fees, or it is international payments or cross-border payments, then definitely they have need, and they are, I think, the main users for crypto and stablecoin payments at the moment.
Yeah. And Uwe, what about you from the compliance perspective? Are you seeing the same trend? How different are the requirements once crypto payments move into regulated financial environments?
I would say that the regulatory expectations are pretty much the same. It's the same set of laws that govern, let's say, anti-money laundering, terrorist financing, and fraud detection. So that is not such a differentiator. But it's interesting to see the breakout from this crypto native community, especially where stable coins are used for trading digital currencies, to real world payments. And for real world payments, you can see how cross-border payments that Eva-Hannes mentioned are certainly up and coming. But let's also not forget that agentic payments are expected to be heavily relying on stable coins. There is an interesting discussion on whether agentic payments will be more reliant on stable coins or tokenized deposits. So we are yet to see that. And one other category that is really important is trading of digital assets. So there are a growing number of asset managers, including the largest financial institutions in the world, who are adopting stablecoin payment infrastructure to facilitate the 24/7 trading and instant settlement of digitized securities, such as then stocks and bills.
That's a very good insight. Thank you. So Hannes, when businesses approach SwapIn, what problem are they usually trying to solve? I'm going to give you a few examples. Is it usually lower costs, or is it faster settlement, maybe cross-border payments, access to new customers? What is it?
It's very hard to say within one sentence because SwapIn is covering a lot of flows. We can help companies to accept crypto as a payment method. Also, we are sitting inside many integrations, working with very different platforms. On the other hand, we are helping companies to send stablecoins out, handle cross-border payments. Some clients, they just want to top up their wallet. So there's a lot of use cases. But I think that if I am giving some examples, then there's more and more how to say questions that the companies wants to start to accept stablecoin payments in the first stage, and in the second stage they also want to start to send them out. And I think this is the trend, or like the main use case at the moment.
Stablecoins. Okay, that's interesting.
Yes,
And
I will explain also why it is so.
sorry?
I will explain why it is so.
Yes.
When we started with Bitcoin, then there was Ethereum and other very volatile coins. Then actually you cannot transfer funds or big amounts, because when it's not stable, no one wants to touch it. But with stable coins, we see the real use case here, and it is becoming more and more effective if you want to just send or pay any invoices like daily basis.
All right. And what do you think, what businesses then often underestimate before implementing those crypto payments?
What I see that even very traditional businesses, even car dealers, all kind of construction, if they need to sell something to third countries and there's no way to send euros to Europe, and here is the exact sweet spot where they can send stable coins. It's fast, it's efficient, and companies can get euros to their account within minutes. If we will take some example, we have one client who are selling goods to Argentina. From Argentina, you cannot send euros out. You can send only US dollars. Then you have to also use one government layer. It will take a week or weeks to send dollars to Europe. It's very how to say, expensive. It's slow, and these payments can be stuck in the banks. But if now we will compare 1 week and 3 minutes, then it's huge difference. We cannot even compare. And also from cost-wise, it's also to send stable coins compared with the dollars 3 or 5 times cheaper. So there's no need to for longer explanation why companies are more and more starting to use that kind of flows.
So you could say that there is a big value in customers that can pay in crypto, while when businesses can still receive fiat.
Yes, exactly.
Yes. So Uwe.
I would actually follow up on this specific question as well, because I think we are this Web 2.5 company, so we are not utilizing Web3 technologies specifically. We run a traditional web app, but it is used to facilitate, let's say, stablecoin or digital currency transactions. And what I see coming from kind of the TradFi space, and also having worked in supply chain finance, is that a lot of traditional businesses, they are a little bit afraid to touch stable coins. They are beginning to hear that it's really good, but they are afraid that they need to set up their custodial wallets, and then they get scared of this word custodial or non-custodial, and it becomes really quite confusing. And if you set up these custodial wallets with regulated businesses, then actually it's not so complicated. But I think a lot of merchants fail to understand that solutions like swapping specifically allow avoiding setting up these custodial wallets and only receiving fiat to their traditional bank accounts. So this distinction it doesn't go without saying, and I think more financial managers should be aware of the two different ways of accepting stablecoin payments.
Good one. And I would also ask then, but what do you think, Uwe? Does crypto to fiat make the compliance part of it easier, or does it introduce an additional complexity from a regulatory perspective?
Well, I mean, if you are a merchant or a supplier of X goods and you're doing cross-border transactions, then as a company that is getting paid or paying in stablecoins, it doesn't really change your regulatory risk. Maybe you should be a little bit mindful of making USDT transfers, but again, it's not exactly prohibited for, let's say, European merchants to own this. What these companies should be mindful of is that for legacy banks, this is potentially unnecessarily a risk factor. So when they see that, okay, this company is getting paid in crypto and has some on-off ramp activities from their bank account, then the banks might kind of get their tails between their legs, right? And that is certainly something to bear in mind. So again, swapping would be a simple solution that allows you to handle stablecoins without an obvious trace to an on-off ramping solution. But yeah, this is the one risk I would encourage people to bear in mind.
All right,
I will
thank you.
jump in here. So definitely it was issue maybe 2, 3, 4, 5 years ago, but well, nowadays, if you are a European registered company, we don't see that the payments will be sent back. This is definitely, let's say, 0.01% when that kind of thing can happen. It was like 2, 3, 4 years ago, maybe a little bit problem, but on nowadays, I don't see that it's like the deal breaker. The understanding about the crypto and stable coins, it's also changed. And when these merchants will explain what they are doing and they are accepting crypto in regulated way, and swapping is company that is using all needed tools to ensure that the service is safe, secure, and etc., then this is definitely what the banks want. So otherwise, if the companies will start to use some MetaMask type of wallet, and nobody knows where the crypto is coming from, then they will use some exchange, and later from exchange to the bank. Then compared with these two flows, then definitely I would say that the swapping flow here is very straightforward, and even for regulated companies, maybe they cannot touch crypto by themselves also, then this is the only solution how to manage that kind of flows.
Yes, very good. So let's talk a little bit about travel rule. And this question comes to you, Uwe, because travel rule has become a major topic for regulated crypto businesses. So for people who aren't working in compliance every day, could you explain what has actually changed in practice?
Yes. So, I mean, first of all, so everybody's on the same page about the meaning of the travel rule requirement. It's a regulation that has been around for more than 20 years, basically, and the traditional payment industry has had 15 years to agree on the travel rule standard and another 15 years to implement it across borders. So now crypto payments are subjected to the same regulation. And what the regulation requires is actually very basic. It has nothing to do with travel in the sense of tourism, and has everything to do with when money travels. So when money travels, it has to be accompanied by metadata. So that would be payer and payee names first and foremost, and then certain other identifiers that would allow you to run conclusive AML, so sanctions and watchlist screening checks first and foremost. Now, as a lot of the listeners would know, then on the blockchain, you don't transmit this information, and you don't want to, because that the information on blockchain is public. So if you now put all the sensitive information on the payment counterparties and maybe invoice numbers and whatnot on chain, then very few businesses would dare to use it. So then it's understandable that the infrastructure to exchange this sensitive information is separate, and then there are travel rule networks such as CryptoSwift out in the world that help the payment institutions or the VASPs and CASPs involved to exchange this information. Evald has disappeared, but I'm sure he will return promptly. So the obligation is to share the payment metadata between the servicing institutions. And in the traditional payments industry, we have national solutions. We have SEPA in Europe that allows you to do it. We have SWIFT that allows you to do it for cross-border payments. So it's not a coincidence that our company name is called CryptoSwift, right? We do what SWIFT does for crypto. But of course, suddenly expecting all these payment institutions to comply with this rule or law that has been around for more than a decade, this is not easy. So there is a transitional period in the industry where all the VASPs and CASPs across many jurisdictions are adopting the travel rule infrastructure. And this is actually quite critical to running traditional financial crime combating measures. So if you have the payer and payee information, then you can do the sanction screenings. If you don't have it, then you can lean on blockchain data. But there is a reason why the Iranian regime has been using stable coins to move their funds, right? You can have very large transactions. They don't pop up as problematic. And then if the KYC is not done, or the companies that service these payments are in jurisdictions that don't care about the flavor of compliance that we do in developed markets, then you can abuse the infrastructure for illicit purposes.
So would you say that the travel rule then now has become just another part of the infrastructure, or does it still create significant friction for the businesses?
It's still in the stage of significant friction. Again, I would encourage viewing this as a transitional phase. So give it another 2-3 years, then there will be more interoperability between travel rule networks such as CryptoSwift, and then different players have different tools, but we talk to each other, so we can exchange information. And the regulators haven't even started to really penalize players for breaching travel rule requirements. But we already hear how regulators are tracking who are exchanging travel rule messages, who are sending them, who are responding to them, because these are separate operations, and they're creating their naughty and nice lists. Naughty and nice lists.
Yeah, that's very interesting. Thank you. And Hannes, what about your company? Has complying with the travel rule changed the way payment providers build or operate their products?
Yeah, definitely. This is one part of the game, and when this is needed, then this is the only way how to handle these flows. And in this case, definitely in the beginning, we had also some questions how to implement it and what kind of solutions to use. But now I see that this is one part, and it's not that we need to discuss. So is it bad or good? So this is like with every new thing. If it is needed, first there's questions, concerns, but now I see it's very smooth.
And I would add that there is the compliance aspect, which is often perceived as a burden, especially if you are, let's say, a cryptocurrency exchange, and then mostly the transactions are between your users' own wallets, self-custodial wallets, on off-ramping wallets, then this travel rule requirement doesn't really make that much sense. But the moment you enter the world of payments, where money is moving to third parties and from third parties, then what actually happens is that, in the regular payment industry, travel rule is almost expected, because you want to be able to track, the name of the counterparty. You want to include it in the transaction statement. You want to include the payment explanation field. So maybe it's a B2B payment, and you should include the invoice number. Like, these are all such elementary properties of fiat payments that if you suddenly don't have them for stablecoin payments, then accountants, auditors, they are really struggling with matching and reconciling the payments. So I would say that the travel rule is actually a massive enabler for the payment use case of stablecoins.
That's interesting. Thank you. And let's talk a bit more about the compliance part as well. You mentioned, Uwe, as well, the compliance, and the compliance is often seen as a cost or an obligation. What do you think, Uwe? Can it actually become like a competitive advantage?
I mean, in certain cases, yes. The main case, I think, is that, imagine you are, a large corporate or a financial institution who is really concerned with reputation, and you want to avoid your infrastructure, your banking and payments infrastructure, from being abused by criminals. At that point, implementing robust compliance checks is something that you do as a way to prevent reputational damage and whatever fines that may come with facilitating fraudulent and illegal payments. So I think in this case, a lot of institutions take it quite seriously. Now, if you come down from that level, where reputation truly matters, then I think it is really more seen as a burden. and also, I have to kind of admit that there are limits to how efficient all these checks are, right? So especially in the current stage of market development, it's not easy to always understand who is behind the wallet, especially if it's a self-custodial wallet. And there are a million ways to circumvent the rules. So if you don't want to have a tight situation, tight ship, then you can avoid it, and then all these rules are meaningless. But if you want to be compliant, then there are ways to do it.
Yeah.
I think this, what just Uwe explained, is like, how to say, pure gold, because these companies who don't want to be compliant, definitely they are going to use other methods to avoid all kind of compliance related questions, or what is related with compliance, KYC, KYT, and also the travel rule, and etc. And here we can divide it for two, like the gray part and then the legit part.
Yes, and so yeah, it's an obligation, but I think if you want to play fair and play big, you gotta, play by the rules.
Yeah, it's the same. Like, you can drive with a car without the license also. Maybe
Yeah.
you wait 10 years, but we are not driving without license, so this is quite similar.
Yes. And what do you think, Hannes, or do you see merchants or business customers paying more attention to compliance today than they did, for example, a few years ago?
Definitely, our clients are mostly from European Union, and they want to work with a European regulated company, and definitely for them this is very important. And also they prefer the solution what eliminates all that kind of risk, what is related with crypto security, volatility, transaction screening, monitoring, etc. And yeah, definitely this is advantage.
That's good. Well, let's talk now a bit about stablecoins, because stablecoins are often described as future of payments. And Hannes, from what you're seeing, are stablecoins actually already becoming practical payment rails for businesses?
Yes, definitely they are. So if we say that stable coins are stable, then definitely the biggest or like top 3, 4 top stable coins, definitely they are holding majority, and we see like even quite big companies are already accepting, sending out, making like transactions using stable coins, and because as I mentioned before, there's a reason they are not doing it because they like it. There's if you are like enthusiast, you are doing sometimes things that you like, but there's real need, and that's why they are doing it.
And Uwe, as stablecoin adoption now grows, what kind of compliance and regulatory challenges become more important?
So, I mean, basically, it's the same set of regulations that govern fiat payments need, or they already apply to stablecoin payments. So now it's a question of how can stablecoin processors comply with this pretty broad set of rules. So again, we've mentioned sanctions and watch screening. You can do on-chain analytics, obviously, which is part and parcel of stablecoin transactions. But something that is done far less is transaction monitoring to identify anomalies, such as again for money laundering or maybe fraud purposes, and the source of wealth checks. So if somebody is suddenly getting onboarded who wants to make a big transfer, or a former already onboarded client wants to suddenly make a transfer that is far bigger than their wallets would imply, then all of these things have to be implemented. And ultimately, there is good news for the industry because for fiat, we had years to develop the regulations, transitional periods to adopt the tools, build the technologies, all of that. And crypto now has a very short amount of time to do that. But luckily, the technology exists. So honestly, the way we look at it is that you can use this orchestration layer for all the different data streams and the risk scoring solutions. So CryptoSwift would offer that type of orchestration for the different capabilities. Then stitching everything together is actually not that difficult. It's just a question of having implementing maybe 4 or 5 tools, and because it is highly automated and the cost of the technology has come down a lot, then it doesn't have to be prohibitively expensive. So something that was maybe only affordable to banks 10 years ago now can be affordable to an up and coming payment institution or fintech. So I'm not afraid of, or I wouldn't be afraid of these regulations once the companies reach a certain scale.
That's a very good answer, because seeing from the MiCA regulation side, the cost for the compliance and everything, if you're not scaled enough and you're a small company, you just don't have the funds to be that compliant and to cover all the costs. So yes, we lost. Yes.
Yeah, just to comment on that, I think it is also one of the maybe difficult news, but for the regulators, having only larger players survive is probably part of the design of the regulation, because small players at low volumes don't have the resources to fight crime. And for regulators, it's much easier to eliminate the small players. It comes at the cost of innovation and maybe certainly job creation and all of that, but it is a much easier market to govern and to make sure that this new breed of companies complies with the regulations that have been introduced for a reason.
And I think eventually it will help along for the adoption as well, because the regular people now see way less of those companies that are now all regulated, and they know that they can, trust more, less likely to get scammed and lose their money, etc.
Exactly. I think what you mentioned here is important, that the financial sector regulations are typically related to consumer protection. This is why they are invented in the first place. One way or another, it boils down to how can we make sure that our businesses and our citizens have access to safe services?
Exactly. I agree. So glad you're back, Hannes, because the next question I would ask from the both of you. And if you had to choose just one, what is currently the biggest barrier preventing wider adoption of crypto payments? So is it banking, regulation, user experience, merchant demand, technical infrastructure, trust? Maybe Hannes, you can go first.
I think user experience, because for the majority this is something new and there's so many questions, and even if you are very like a simple platform or product with very straightforward solution, so then the question is how it can be so simple. So definitely this is like the bottleneck, but we need to educate the audience, the clients, and I think it will come step by step and it will just take some time.
And Dora?
Yeah, I mean, I would look at it from the perspective of what problem is the product solving, right? So in Europe, we have the Eurozone, we have SEPA payments, money moves, in most cases in under 10 seconds. So for the real world payment use case across borders in Europe, we honestly don't need stablecoins. If you think about the developing markets, then this is where they add very specific value, especially if you're doing, I don't know, trade between two African countries or like, Asian and Latin countries. Then the Swift rails are very cumbersome, and now you have this far more distributed technology that allows, a VASP in Indonesia to do business with a VASP in Brazil and facilitate payments that way. America, interestingly, is also actually from a real world payments perspective not that developed. We don't think of it that way, but the national clearing system that the US has is not very fast and cost efficient. So there are reasons why solutions like PayPal and Venmo took off there, and I think stablecoins have room for success in the US largely for the same reasons. So yeah, this is one thing. But other than that, I agree with Hannes, because if it's user experience is complicated and you don't have, for let's say business to business payments, the elementary metadata, then merchants will not be adopting it because they cannot reasonably set up their operations.
Yes, and my example was more like how to say European based. I relied to my experience. But here I need to yes agree with Uwe that there are like two different worlds. If we will take Europe or even Baltic states, where the internet banking started more than 20 years ago, and even I remember times when I went to Germany and I told to my partner, okay, I don't have so much money with me, but give me 10 minutes and I will use your computer. I will send you the money. Then they thought that it's some joke. Then I use my code cards and I forward the funds. And for them, was like from another dimension. And they thought that this is some kind of game. And then the transfer wasn't so fast, but on the next morning, they used their bank card and check it. And then they came back and told, yes, it's working. And I was like, I don't know, from for them, like God, who can move money using their computer. And this is actually the situation same if we will take Africa or Latam, some even neighbor countries, they don't have politically good relations. And if you need to trade between these countries or companies, basically till now they are using a lot of cash or some middlemen. But with stablecoins, this will open a lot of new opportunities. And regarding user experience also, when there's like smaller companies, they don't have wallet infrastructure, the funds will be managed only by the CEO himself. It's much easier. But if you will take some example that you have company in Europe and you have 500 team members, and 20 from them wants to get access for the wallet, and you have only one wallet with one password, then one day the wallet can be empty and where to start. So these are like very different use cases, and there's different needs. Also, as Uwe mentioned, different expectations. If you need to audit your company and you are using some just called Web3 wallet, it's like basically impossible. Auditors will see only some numbers, but they don't know who is behind these or who are behind these numbers. It is very important.
Yes, thank you. Very good perspectives from both of you. And now let's look a little bit into the future. So Hannes, looking ahead 2 or 3 years, what developments do you think will have the biggest impact on crypto payments?
Do you mean in currency-wise or the use case-wise?
In any way, how overall, I think. What do you think would be the biggest?
We are seeing and analyzing the trends, then definitely the stablecoin adoption will continue. There will be, I think, coming some more stablecoins. Are they like more some country-based or even some like I think corporate-based stablecoins? Regarding use cases, I think that in Europe there won't change so much because the payments are very like fast, cheap, smooth. I think it will be also within next 2-3 years. So, but in overall, I think if we will take third countries like Latam, Africa, and they want to trade with the Middle East, then definitely I think key role will be for stablecoin use cases and adoption.
Interesting. And Uwe, from the regulatory side, what changes would make it easier for businesses to adopt crypto payment infrastructure?
Well, I think in the European case, there is one massive blocker, which is that transfers from a custodial wallet that has been set up by a regulated, wallet or crypto payment service provider, payments from these wallets to self-custodial wallets are only permitted if they are to the user's own wallet. This is for transactions larger than €1,000, right? Below €1,000, I can send money to Silva Kairet's wallet or Eva-Hannes's wallet. This is all fine, and the regulation is flexible. But this is user-to-user payments, maybe some small merchant payments. But for actual trade and P2P payments, this threshold is far too low. And I think that removing this threshold, so allowing payments to third-party unhosted wallets, would be an important restriction that has to be lifted. Now, I understand why this is in place. Regulators view transactions with self-hosted wallets just like cash transactions. So they are highly suspectable. And if somebody brings a large amount of cash, then I think there is reason to question what's going on here. So somebody somewhere has just evaded taxes or received payment for something illicit. So it's used the same way. Now, there is a technological question on how you can move it to a higher quality category or lower risk category than cash, and namely under the European Union digital identity scheme that is being rolled out. It will be quite easy to cryptographically bind the wallet, the self-hosted wallet, to the identity of the user who is commanding the device. Because in these EUDI wallets, you will be able to kind of have your KYC information, but also certify ownership or control over an unhosted wallet. And once that rule or once that proof has been provided, it's not this illicit cash transaction anymore. Then you can see that, yeah, okay, this is declared person, a known person. You can do all the checks, you can do all the paper trails that are required. So that would be one significant regulatory change.
That's very interesting, and I agree, because Comply.Once, where I am working currently, we're building the solution the same way, and it would absolutely change the game. And if they could remove this $1,000 or €1,000 limit. So finally, the last question. And if there's one message, that's for both of you, if there's one message you would like businesses to take away from today's discussion, what would it be? Let's go with Hannes.
Don't miss the train.
Sorry? Don't miss the train.
Don't miss the train, yes. Yes, and it's like very simple reason. If you want to implement like full scale, it might be like a too big step. But first of all, you can start with accepting crypto. Later, you can start to invest to crypto assets if you want. You can start to use stablecoin payments daily basis. But just start to accept crypto payments. It's very easy, and then you are already in.
Nice.
I would maybe finish with not exactly a provocative thought, but something that still kind of makes you wonder. What I see is that these days crypto is the industry where the least compliant and the most compliant financial sector actors are getting together. So if you go to a big event, you will maybe find some shady OTC desks that will offer you ways of laundering money or whatnot, and then you will have like JP Morgan and BNP Paribas and Credit Agricole and everybody hanging out at the same event. And I think it's worth thinking why these large institutions are investing in the technology, and considering if as a merchant or consumer you have something to benefit from that direction.
That's very cool. Thank you, Ove. And thank you everyone who joined us today for this discussion. And today's conversation definitely showed us that the future of crypto payments is no longer just about using digital assets to make payments. It's about building infrastructure that businesses, banks, regulators, and users can all trust. And as we've heard today, that requires the right balance of innovation, compliance, and usability. So thank you everyone who joined us today. We hope you found the discussion valuable, and have a great day. Bye.
Thank you very much.